Attention on the 2024 U.S. election has been rising to a fever pitch ever since Vice President Kamala Harris stepped in to replace Joe Biden in a presidential race against Donald Trump.
With each new poll and headline, the election season often stirs up emotions in investors. But did you know that elections can cause investors to behave irrationally? Avoid cracking under political pressure by dodging these 3 common election year mistakes. Number 1. Basing investments on a political party. Will a Republican or Democrat win dictate how the market performs? Data since 1932 indicates not. You'll notice that markets have typically declined during the first 5 months of an election year, but they have generally rebounded quickly. Stocks gained an average of 11.3% over the 12 months following primary elections, likely from investor confidence recovering. A common generalization is that a Republican president would introduce pro-business policies leading to better market performance, but studies have shown that markets don't favor a particular president's party. Instead, markets have been impacted more by Congress and have performed best when it's divided, as splits offer market stability by making polarized policies harder to enact. Though during majority Congress, markets have favored Republican leadership under both presidential leads. Second mistake. Picking investments based on policy and sector. Choosing stocks based on electoral promises can be a major risk. It's impossible to predict who will win and when their policies will take effect. In fact, data since 1976 shows there's little connection between policy changes and how sectors perform. Whether a sector did better or worse than the S&P 500 doesn't consistently match which party was elected that year. And finally, number 3, trying to time the market. Let's face it, political events can make us emotional, but investing decisions shouldn't be swayed by short-term headlines. While elections can cause some temporary market fluctuations, the reality is that long-term returns are far more influenced by the overall economy, monetary policy such as interest rate changes, and corporate returns. So, instead of stressing over political speculation, adapt to concrete changes that could impact your portfolio long-term. Why should Canadians care about U.S. politics? Keeping a pulse on American headlines is crucial as the US is Canada's largest trading partner. Their actions significantly impact our market and economy, but lasting change rarely stems from election season. For example, if a US policy promoting oil trade is enacted, Canada's concentrated energy sector may experience a boost, though the policy wouldn't necessarily be timely or tied to an election. Additionally, many Canadian investors have exposure to U.S. investments, either directly through a stock or indirectly through a fund, such as an ETF with U.S. holdings. So if you're an investor that's more active and less diversified, following U.S. news may help you find investing opportunities and make adjustments for upcoming market changes. In the meantime, stay cool and collected by checking out our video, How Can I Invest While Keeping My Emotions in Check, on YouTube and the Learning Center.